Bismillahirrahmanirrahim. Welcome to the Bank Negara quarterly press conference. The global economy continued to experience modest growth in the second quarter. Economic activity in the advanced economies remained weak, and while growth in the emerging economies remained supported by domestic demand, it was at a slower pace as the prolonged weakness in the external sector began to have a more widespread effect on the domestic economy. And international financial markets during the quarter experienced increased volatility during the quarter due to the possibility of an earlier than expected scale back in the quantitative easing in the United States. And the slower expansion in several other Asian economies follows the period of prolonged weakness in the external environment, which has affected domestic demand in these economies and, of course, in the Malaysian economy as well. While domestic demand in the Malaysian economy has remained strong, the prolonged weakness in the external sector has adversely affected our overall growth performance. In the second quarter, the Malaysian economy expanded by 4.3%, and growth continued to be supported by strong domestic demand, particularly in private sector consumption and investment activity. Beginning this quarter, the Department of Statistics will also be releasing the official GDP figures on a quarter-on-quarter seasonally adjusted basis. For the quarter-on-quarter growth, the Malaysian economy expanded by 1.4% on a seasonally adjusted basis. So, in other words, we have seen an improvement from the first quarter. Going forward, the external sector is expected to improve in the second half of the year, and therefore we expect a better performance. However, given the more moderate growth performance in the first half of the year, the bank has now revised the growth outlook for 2013 to be within the range of 4.5 to 5% from the earlier 5 to 6%. In the second quarter, exports contracted further due to the continued weak global demand for electronic and electrical products and the lower prices of major commodities, and this account for the main reason for the affecting our overall growth performance. In addition, import growth was, however, sustained with higher imports of consumption and intermediate imports, although imports of capital goods during the quarter was lower. The increase in consumption imports was led by demand for processed food and beverages and durable consumer goods. Given weak global demand and lower commodity prices, the current account surplus narrowed in the second quarter to 2.6 billion ringgit, or 1.1 of GNI. The goods surplus was therefore lower as imports continued to outpace exports, while the services and income accounts continued to record deficits. Malaysia's exports has been affected by the prolonged weakness in the global economy and the declining commodity prices. Exports are, however, expected to gradually improve, with a modest global recovery expected in the second half of the year. And Malaysia's external position is also affected by the strong domestic demand, in particular investment activity, and which has led to relatively strong import growth. So as you know, the income accounts that measures growth looks at net exports of goods and services and this has become a significant negative because of the negative growth in exports, while import growth continues. Domestic demand, however, has remained on a steady growth trajectory, increasing strongly by 7.3%. Therefore, our domestic economy continues to be in the 7% range, growing at 7.3% in the second quarter. Growth was driven by higher private consumption, underpinned by sustained income growth and favorable labor market conditions. Private consumption remained the largest contributor to growth, expanding by 7.2% during the quarter. The expansion of gross fixed capital formation continued, supported by capital spending by the private sector. Private investment activity still grew by double digit by 12.7% during the quarter. Public sector, however, also continued to support growth. Growth of fixed capital formation continued to expand at 6%, underpinned by continued capital spending by the private sector. And as I mentioned, the private investment activity increased by 12.7%, led by capital spending in the domestic-oriented subsectors such as telecommunications and real estate, and ongoing implementation of projects in the oil and gas sector. Public investment, however, declined by 6.4%. Investment by the non-financial public enterprises, however, continued to expand, particularly in oil and gas, telecommunications, and utility sectors. But this was outweighed by the lower federal government development expenditure. On the supply side, the services and manufacturing sectors continued to expand, driven by largely domestic-oriented subsectors. The services sector registered a growth of 4.8%, supported by mainly the subsectors supporting domestic demand, and household spending continued to drive growth in the retail subsector, while the wholesale segment moderated in tandem with slower trade activity. Value-added growth in the agricultural sector moderated to just 0.4%, while the mining sector expanded by 4.1%. And the moderation in the agricultural sector was mainly because of lower production of natural rubber and more moderate growth of crude palm oil production. The rise in the mining sector reflected stronger growth in both crude oil and natural gas output following ongoing efforts to enhance production from new and existing oil fields. Growth in the construction sector remained strong at 9.9%, driven by the residential and civil engineering subsectors and the construction of high-end properties in the Klang Valley and Penang, and continued progress in the various infrastructure and oil and gas projects also reinforced growth of this sector. The manufacturing sector expanded by 3.3%, benefiting from the strong performance of the domestic-oriented industries and improvement in the export-oriented industries. Growth in the domestic-oriented industries increased by 6.5%, supported by continued economic activity in the consumer and construction-related clusters. And the export-oriented industry registered a growth of only 1.3%, mainly due to higher production of chemicals and refined petroleum products. On the inflation front, headline inflation, as measured by the annual change in the Consumer Price Index, increased by 1.8% in the second quarter of 2013. However, the overall level remains modest. High prices were driven mainly by supply factors, and inflation in the food, and non-alcoholic beverages category increased during the quarter, while prices in housing, water, electricity, gas, and other fuels category were also higher, reflecting increase in the rental during the quarter. And I believe that the number for July is also being released. Do we know what the date of the release is? The Department of Statistics. When is the number for inflation? Is it today? Pardon? Pardon? Today. Then I can mention it?
Yes.
Yes.
Okay, bagus.
It's embargoed for today. So, all right, the latest number is also released today, and it is 2%. So we did say that the rate of inflation would be in the range of 2 to 3%, and but the average for the first half of the year still remains low, and it is only now that we are seeing 2% for the inflation. During the second quarter of 2013, the OPR was left unchanged at 3%, and this reflects the assessment made by the Monetary Policy Committee to hold interest rates steady. While inflation is expected to rise during the year, its overall level is projected to remain modest, and domestic supply and cost factors are expected to be the main drivers of inflation, as domestic demand pressures will remain contained. At the level of the OPR, monetary policy remains supportive of economic activity, and lending rates in particular continue to remain at relatively low levels. Retail deposits rates also remain stable during the quarter, as the average quoted fixed deposit rates of commercial banks were unchanged. The growth in net financing through the banking system and the private debt securities market moderated from 11% to 9.1% at end June, and there was some moderation in lending to households, as household loans outstanding grew at a pace of 11.8% as at end June, compared to 12.1% in March 2013. So we are seeing some effect of the measures that we have introduced earlier, and this is what we want to see. We don't want to see an over-adjustment in lending. All those who are credit-worthy should have access to financing, but there should be moderations so that household indebtedness remains at more sustainable levels. Despite highly volatile capital flows, ringgit adjustment has remained orderly. The ringgit depreciated against the US dollar by 2.8% in the second quarter of this year, following the trend of other regional currencies. And this was prompted by the discussions that has taken place on the possible tapering of the monetary accommodation in the United States. And this has resulted in a significant withdrawal of funds from emerging markets, including from our region. So against the other major regional currencies, the ringgit performance ranged from an appreciation of 3.4% to a depreciation of 4.6%. And the trend continued in July and the first half of August, as we all know. And between first quarter 2013 and the 20th of August 2013, the ringgit depreciation is 6.4% against the US dollar, much the same as other regional currencies, most of which depreciated by between 0.9 and 7.5%. And the exception, of course, is the Chinese renminbi, which strengthened by 1.4%. Turning now to our financial system, the domestic financial system stability remained preserved during the quarter, and financial intermediation continued to be well supported by institutional soundness. In other words, all our banks remained sound and solid. Banks were well capitalized under the more stringent Basel III capital requirements, which was being implemented progressively in Malaysia beginning January of this year, and the total capital ratio and the common equity tier 1 capital ratio were 13.8% and 11.7% respectively as at end June this year. And the capital adequacy ratio of the insurance sector was also equally strong at 220.8%. And in addition, the credit market and liquidity risks of the financial institutions remain manageable. Despite the highly volatile international financial flows, the domestic financial markets remain orderly, and the assessment of our financial system was also reinforced by stress test results which affirm the strong capacity of the Malaysian financial system to withstand the adverse macroeconomic scenarios and financial market conditions. So this is one of Malaysia's strengths that we can count on to support our fundamentals and our economy. Portfolio flows continue to be well intermediated by our financial system. Equity, bond, and interest swap prices continue to closely track domestic and external developments. The Malaysian government security yields continued to rise in July on the expectations of possible US Federal Reserve quantitative easing tapering in the latter part of the year. And interest rate swaps also rose in tandem, reflecting market expectations of rising bond yields. So market liquidity in the domestic equity and bond market remained intact, with stable turnover ratios and bid-ask spreads. Stress tests carried out at the system-wide and entity levels affirmed that financial system is resilient to potential price shocks even under the assumptions of extreme market volatility. In the second quarter of this year, aggregate household financial assets expanded at a stronger pace, driven mainly by higher value of investments in unit trusts and funds and equities, in line with favorable conditions in the equity market. Household debt, which comprised borrowings from banks and non-banks credit providers, continued to comprise mainly of housing loans and personal financing. The bulk of the expansion in personal financing to households was by non-bank credit providers. The overall debt servicing capacity of households remains sound, with a ratio of banks' impaired loans and loans in arrears of between 1 and 3 months for the household sector remains stable at 1.3% and 2.2% respectively. So in other words, these non-performing loans of the household sector still remains very low. Additional measures were introduced in July this year to complement earlier measures aimed at further promoting a sound and sustainable household sector, and this will be further supported by more efforts on financial education and literacy to facilitate more sustainable change in consumer behavior and spending habits. So while the external environment is expected to improve, with some improvement in the global recovery, it is expected that it will continue to be challenging. So we are expecting a challenging environment with some improvements going forward into the second half of this year. Factors underpinning domestic demand are, however, expected to remain on a solid and steady growth trajectory. Domestic demand will remain an anchor to our growth. Private consumption is expected to remain strong, underpinned by positive prospects for income growth and stable labor market conditions. Investment activity will be led by business spending in domestic-oriented sectors and infrastructure projects with long gestation periods. And the financial system is also well capitalized to support financing of these economic activities. So this concludes the presentation, and we will be pleased to respond.